Danielle Park is a chartered financial analyst, president and portfolio manager for Venable Park Investment Counsel, Inc., the independent investment counsel firm she co-founded. In this capacity, she helps manage the portfolios of more than 200 of North America's wealthiest families. She is noted for groundbreaking work in educating industry professionals and investors on the risk and realities of investment behaviors. Ms. Park is the author of the best-selling myth-busting book, Juggling, Dynamite, and Insider's Wisdom About Money, Management, Markets, and Wealth at Last. Her topic today is entitled, What a Slower Growth World Tells Us About Present Stock Valuations and Gurus. Please welcome Ms. Danielle Park.
Good morning. My clicker's here. All right, so the presentation I'd like to do today is to give you a big picture of where I think we are presently in terms of price and risk markets in the world and what I think that portends for the next perhaps 12 months or so. And I think, you know, as I've been speaking at these shows now for the last 5 or 6 years, I think what the perma-bull crowd gets wrong, what they got wrong in 2007, what they got wrong again in 2011, and I think what they're making a mistake on today is this idea that they aren't recognizing the shift that happened with the credit bubble bursting in 2008. So there was an incredible pop-up in world demand and world growth that was infused by the credit bubble. And that ran from when Alan Greenspan cut interest rates in the United States to 1% in 2003. You saw the huge inflation in real estate and consumer credit thereon, and that went to about 2007. So what we are in now, and I've been showing a chart similar to this for the past 5 years, and my point was simply, if world growth peaked at 5.2% in 2007, and now the credit bubble is behind us, then we should expect to have quite a bit lower growth going forward. Now, my sort of rule of thumb was, by the calculations and guesstimates that I could do, that I thought we might see world growth around 3% in the after-bubble period. Interestingly, the IMF recently confirmed that in 2012, world growth was actually 2.2%. So actually, I wasn't pessimistic enough, I guess, in terms of what the growth rate would look like after the bubble burst. So in this new world, we have to face the fact that global growth has come down by about half. It was unsustainable at the 5% level that it was at. The credit bubble was unsustainable, so this is all part of a correcting process. It's natural, it's healthy in the long run, but the reality of it has to be grappled with when you're making forecasts about what you think demand cycles will look like from here, or what you think prices will look like from here. And so when you look at this chart of the commodities sector, the CRB index, you see that enormous run-up that I just mentioned with the credit bubble to the peak in 2008. You see that huge correction. You see some recovery on the stimulus efforts that went on in central banks around the world. So the QE1, 2, 3, the LTRs, O's out of the Eurozone. The central bankers of the world pumping in liquidity to try and reinflate the bubble. And I will go on to show you that I think they've been unsuccessful in terms of the real economy. So what that tells us, and another thing that's often missed, at the beginning of the early 2000s, when commodities had been unloved for a long period of time and underinvested for a long period of time as everyone had been in love with tech and technology, what happened was you had this negative correlation, or almost negative correlation, between equities in general and commodities and commodity prices. And so you could relatively expect to have some diversity benefit if you were holding hard assets versus paper assets or shares because they weren't directly correlated. What happened in the last 10 years is that the story became, started out as all bullish stories do, widely disbelieved, very few people buy in. As it goes along, you get more and more people building in the belief and watching the price trends go up. And in the final few years, you get a mammoth force of people on the sell side of that story. And then it becomes part of the certainty accepted by the populace. So everyone only sees a continuation of that trend, even though it's gone on incredibly far and incredibly long. And now what you had was a financialization of commodities and hard assets, so that everyone was selling you a commodities fund, index, ETF, managed strategy of some kind. And those are paper versions of hard assets. And so not surprisingly, they also burst with the stock market in 2007-8, and they too have had some fluctuation in the last couple of years as these efforts have tried to reinflate. But today we have a very strong correlation between paper assets and hard asset prices. So you should not expect them to decouple in this environment or give you a great deal of diversity benefit. So the credit bubble took Chinese stocks. That gold box, I think, is very instructive for the point I'm trying to make. You see that you have the Shanghai index take off. You know, it comes into the World Trade Organization, China, but also the stock market becomes part of this belief in the growth phase, the hyper-growth phase that was possible because of the credit bubble. So you see that the venture exchange and the Shanghai exchange and the S&P, everything basically rose in concert during that period, went to a crescendo, and then, of course, bust at the same time, to everyone's shock and dismay. Now, off the bottom, you've also seen this remarkable correlation as money flow came back in. And actually, 2009 was a cyclical buying opportunity within this long-term trend that I'm talking about. There was one in 2003, and there was a very valuable one in 2009. The problem is that since 2010, that disconnect has become a great risk to capital once again, and that's why I think you've seen further losses in the sector. So what I'd like to point out here is a gap right now. In the last quarter of 2012, as Chinese stocks continue to weaken, junior mining, major resource companies, everything basically in that sector continued to see outflows and weakness, but the S&P 500, as the broad market benchmark, responded to the hype and euphoria of the federal funds injections. Now, I think that this gap is not long for this world. So what we now have is a phase where people have come to have a ubiquitous faith in central bank intervention. And I noticed that this is the new mass psyche. It seems that everyone that I speak to is convinced of late that the central bankers will have their way come hell or high water, that you can't fight the Fed, that liquidity is all a market needs. I would suggest to you that even though they have ramped up the central bank balance sheets over the past few years, what we've seen is there's been no transmission into the real economy. That's why job growth has not come back. That's why we are not performing at anywhere near what the global economy was at the peak of the credit bubble. It is not being lent out, it is not being borrowed by business, and it is not reinvigorating growth in the economy. And so as a result of that, you see that in 2012, we actually did enter a recession in Europe, the UK, and Japan. And I would suggest to you that the data is now saying that that is likely to be the case in the United States and Canada potentially in the very not too distant future. So Chinese export and import growth, again, back to this theme of they tried the QEs, they pumped in the liquidity off the bottom in 2009, they got some bang for their buck up to about 2010, and then we saw a dramatic falling off again in terms of consumption, in terms of exports and imports, pretty much all over the world. And China is no exception to that, because the fact of the matter is that what we have as a hangover from these efforts to reinflate is massive debt everywhere now. So in fact, we are actually worse than we were in 2008 because we have spent a lot of good money after bad. And that is the case in China as well, where now they are suffering from the worst winter weather-wise that they've seen in many years, and a food crisis that's coming from that, as well as a lot of domestic debt. So you have total debt now in China above 200% of their GDP. That's rarely mentioned, right? People still have the belief or the mindset that China is full of cash and they're the least levered and no problem, they'll be able to save the world. I suggest to you they have a lot of domestic issues right now which are going to take a lot of their attention. And if the political process is to remain in any way stable, they're going to have to placate the people with some kind of help in their real economy, not just in the banking system. So the output gap, and this is again the source of great dissatisfaction for real people, real working people, the output gap is that amount of capacity the economy is capable of over what demand is actually taking. And the fact is, because infrastructure was bumped up on the credit bubble demand, because there was such extensive overinvestment, there was also great oversupply when demand finally bust. And we have seen that continue, and especially in the commodities sector. Same with the real estate cycle. It's a slow-moving beast, right? There's a lot of plans and projects put into the works well before the bust that just don't stop on a dime once the demand turns down. They keep cranking out shopping centers, whether or not consumers are coming to the stores which are presently there. The life cycle of that planning just has a certain momentum, and it goes on longer than anybody needs. And I would suggest to you that we are there again in terms of the capacity in the world being much greater than demand is currently using. But even if we weren't in this kind of a really, as I say, over-indebted, actually worse position than we were at the peak in 2007-8, we would be due for a global recession any day now. It's just the way it works. A business cycle is alive and well, whether you're in a secular bear or a secular bull period in a particular point in history. And that's roughly every 4 years. On average, this just shows you the duration off the bottom of every bull market that we've seen for the last 100 years or so. And so the point is that we are now 4 full years from the bottom in 2009. We ought to be looking for the cyclical pullback even in the most normal of conditions, and I'd submit to you that this is anything but the most normal aftermath of the last recession. So we do see that capital goods, which tends to lead the manufacturing, capital goods orders is a leading indicator of this. In the United States, for example, has been turning down through 2010 to 12 and is now suggesting that GDP has quite a bit further to go to the downside. And that's kind of significant because we know that we ended 2012 on a relatively weak note in the United States, where growth was something maybe between 1% and 2%. And now we're heading into the aftermath of the fiscal deal that was struck. So although they came up with very few cuts to spending, anemic at best, there are some kicking in March. And although that they raised the taxes, to try and increase revenue, the reality is that that too will have a hit to GDP in 2013. So no matter what, you come from weak growth around somewhere just north of 1 in the fourth quarter to losing probably a couple of % off the U.S. GDP in 2013. This is why I suggest to you that the evidence is more likely to show a recession in 13 than not. Small businesses seem to get this, right? They haven't been bailed out. They haven't been given free money. The survey after survey says that their concern, the thing that's holding them back in optimism is not government wrangling or whether or not they can get loans. Actually, they're not looking for loans right now. Their concern is customers. They don't have enough customers. And that continues to be the threat in terms of the job recovery, because anyone who's run a business knows if your overhead is too high, too long, it creates debt and it puts you in a precarious financial position. This is why small business are now not planning to add to their workforce again heading into 2013. So you can see that this trend again suggests that we're more likely to see a contraction in growth than anything on the very positive upside, at least in the next couple or 3 quarters. Again, coming to the end of 2012, you had corporate guidance in the S&P 500 companies at the most negative we've seen since 2007. Okay, 2007 being when small business was also looking into the canyon of growth falling off and customers weak, and sort of were concerned about where their revenue was coming from as they looked forward. They're saying that again today. This chart is very instructive because this is what I'm talking about in terms of global manufacturing, that blue line. You see that it was recovered from the 09 bottom to about 2010. And then it struggled, weakened, and has been falling ever since. The yellow line is actually global stocks, and those green lines are the injections of the Fed money or the LTRO in the Eurozone. So every time central banks throw some cash at the thing, it has some immediate effect, mostly on algo traders, frankly, people who are flipping in and out of these things on a daily basis. They're not doing a lot to endear the hearts of investors, long-term people who are leery of losing money. They're not excited by valuations that were already already overpricing global growth, and thanks to infusions of quick money, it tends to overprice that even further. That's not attractive when you're looking at things on an investment perspective. It's really akin to what I've seen in some corporations in the last couple of years. They've used the wonderfully low interest rates, if you're a borrower, to borrow money, which is probably prudent if you need long-term capital, but the mistake has been that they have then turned around and bought back their shares. This is again akin to what the central banks have done. They've taken on debt, governments have taken on debt, but not to invest in the real economy, not to create greater efficiency, not to educate the workforce, but to try and prop up asset prices. And what you find is it's an absolutely non-productive use of capital. And at the end of that, you realize that you've made a big mistake and now you've got more debt than you had before. So I think that's what's been happening with the global debt market and global stock markets in the last couple of years. Now, as we track the macro data in the United States, this just gives you another confirmation. We saw similar patterns at the peak of each of the last two cycles, whether it was in 2000 or in 2007. Basically, the macro indicators turned down in the stock market, in this case just the S&P in particular, has ramped up just as the economic picture weakens. That gap is the source of investment risk. So the other thing, as I spoke of the ubiquitous belief in Fed policies, is I've noticed that this is actually the Investors Intelligence Survey of newsletter writers. There are twice as many bulls today as there are bears. And I can tell you something, this is a leading indicator, contrary, because those very people were the most bearish possible in 2009. So the gurus tend to be exactly the opposite of what you want to be doing in terms of their bullish and bearish sentiment. I think that the motivation of late seems to be the people that were uber bullish at the top, didn't suggest anybody take profits or sell, rode the thing down into the ground, were decimated, devastated, depressed, very bearish at the bottom. Then they saw a hope that the central banks would save everyone, and into 2011 they became uber bullish again in hopes they'd get back what they lost, or that their readers would, or they'd retain some credibility. And I think what you've seen in the last while is they're now more desperate than ever. Because as the global economy turns down and we face the prospects of the next recession, the capital losses in the third go-round are going to be a deal breaker for the retail investors who have, so far they've been leaving quarter after quarter after quarter for the last 6 years. I suggest to you this will be the final blow that will probably bring capitulation and the end of this secular bear. So that's the upside. But the net speculative long positions right now in the S&P 500 are again back to about where we saw at the peak of the bubble in 07. So that also tells you that there's a lot of speculation on leverage. And there again is the margin debt use into 2012, vying with the levels we saw again back in 07. And this matters because if you're an investor and you're trying to make an actual prudent allocation of capital, based on management or a story or a sector or growth you anticipate. And half or two-thirds of the people that are there with you are just levered traders. That means that as soon as price moves down, even incrementally, they will begin to sell. And as it moves down further, they will sell further, and they will suddenly be in a panic to cover their margin. That's the risk you face when you're participating in thinly volumed markets. You don't want to be the only two investors in a bunch of crack addicts. It's not healthy or safe for your capital. So here's the other thing that's ironic is that dividend yields are now back to about 2%, for example, on the S&P, but really every sector. People have been so desperate for yield as interest rates have come down the past couple of years that they've bought up every single thing they could get their hands on. Junk bonds, which come with the highest risk to capital, are currently paying less than 6%. People have paid such a large premium for them, they are now pricing them the way you would normally price, first world debt, like short bonds of a government. So they're priced as if there's no risk, when in fact they're full of great risk at this point. So the PE is overdone. It's 22 times earnings presently on a Case-Shiller, which is a 10-year average, which is healthy, because don't forget, if you're just forecasting a short period of time, and part of that period was the credit bubble, and you're expecting those earnings to pop up anytime soon, you're doing so in the face of global growth, which is less than half. You have to keep in mind who the customers are going to be in this environment. So what it tells us is that traditionally, when PEs are this high, when Optimism and the participants have overpaid this much, you see flat to modest returns over the following 5 years. So, you know, when everyone's desperate to get in, that's probably exactly the right time to be out. The same goes with the dividend yield. This is what I was referring to. Historically, whenever we've been around 2%, because prices are so high, the income's not sufficient to compensate for the risk, and you see that returns over the next 10-year period are pathetic. This has been the case from the peak in 2000 and the peak in 2007, and it's exactly why returns have been negative for anybody trying to hold stocks during the last 13 years. So everyone's bullish today. Everyone that's you know, in the business of selling risk, everyone that's underperformed their benchmarks for the last 13 years, they're all very bullish and hopeful again. And you know, what could possibly go wrong? Well, it's called the business cycle. And as I say, if you see this downturn, which is already confirmed in the data in most of the world's developed countries, is very likely to show up in Canada. It's already started in our earnings and revenue reports of late. So you see this main theme: slowing global growth, lower earnings, and margin calls are the main headwinds to your capital invested today. We're not living in a bubble here. We are completely connected to this whole global story. And the US dollar, again, you know, ramped up with great optimism in the 1990s, 50% appreciation against the Canadian dollar and others, has fallen 40% since that peak in 2001, as the fiscal cliff already happened, folks. The fiscal cliff was the overspending and the falling revenue and the pretending like that didn't matter. So that happened as the US dollar collapsed into the bottom of 2008. And it's been seeing significant inflows since. If that continues, our upside target on this index is 88, just because that's where cyclical support has been the last couple of times. And if that's the case, that portends, again, significant downside to risk assets, to the Canadian dollar, again, which will be helpful in the long run because we need some exports, but in the short run, it's a risk for your capital. And the other factor here is that the Canadian venture commodities, that whole sector, when I talked about the mammoth push to sell that story that we saw going into the peak in 08, we saw a lot of speculative inflows. We saw a lot of pensions even pretending they could allocate on, you know, as if this was a legitimate asset class they could just invest in on a long-term window. And in fact, they lost their shirt. And then what happens is the next quarterly meeting, the pensions start to cut their losses, right? Because they are terrified of reporting that they keep losing money quarter after quarter. They're going to get fired. So what you see is you see money that was supposedly long-term investing in the sector actually starts to pile out. And we've seen that. We saw that last year. The commodities hedge funds, which were, you know, great bulls and very confident, have been pulling back capital throughout the last couple of years, and they did so again in 2012. So long as those players are continuing to leave, you know, it's sort of like standing at the door saying, wait, don't go, I think it's nice in here, and they're not interested. They're leaving, and that capital has to be accounted for. So when I look at the Canadian Venture Exchange today, I would have to tell you that I'm more optimistic now than I was in 2007-08. This is a chart of it. I'm more optimistic now than I was at that interim, you know, peak again in 2011 when everyone was hoping that the QEs would solve the thing. But I'm not sure that you've seen the bottom yet, and I know people would like me to say that I think that the bottom's in, but the reality is the North American recession is not yet priced into this price cycle. And though I believe that the S&P is something like 45% overvalued in this environment, it's probable that the mining sector is possibly still somewhat, maybe 20% overvalued in this environment. So we've made important work to the downside. It's not like the end of the world doom and gloom, but the trick is going to be who can manage their cash to get through this next contraction in world demand. And you may in fact see that the last speaker was talking about the inventory and the stockpile in China and Asia, and it's there for sure. But keep in mind that at the peak of the growth boom in the credit bubble, China was growing north of 11%, 12% GDP growth. And so even if they can manage to keep it at 7 or 8, that's a dramatic downshift. And now they have wage pressure, inflation in food and wages. They're no longer as competitive. There's cheaper countries who will make stuff. So they have a lot of domestic policy issues. I think you'll probably see them sell a lot of their inventory and stockpile, or some of it, over the next couple of years. So people are counting that inventory stockpile as if it's golden. It's never going to be sold on the open market. They're going to always be buyers, right? There'll always be price takers when there's any softness. I suggest to you that that isn't necessarily the case when they're facing declining cash flow themselves and when they need to raise money to remedy some of the things in their own economy. The fact is that they still they have weaker domestic demand today in China than they did in 2000. That people are saving more, and now they've bought housing and they have housing debt, and they have still modest income. So yes, there's people moving from farms into cities, but they're also facing the demographic downshift, where now the one-child policy is coming back to haunt them, and they're seeing their workforce actually decline year over year. So again, this is like Apple, this is like Microsoft, this is like any great story where everybody becomes so certain that it can only continue at that rapid pace. And then suddenly, when everybody's bought, when it's already the top owning, when everyone that's in can be in, suddenly it disappoints. And that is the story of the China miracle, I think, that we've seen in the last couple of years. The TSX has more downside risk than the venture exchange because it's been levitating more on banks and bank earnings, which are now, bank shares are back at nosebleed levels as retired people have been driven to try and grab yield from these conservative dividend-paying famous last words before your capital loses 50%. So Canadian market, again, I'm more optimistic than that peak in '07 when it was just ridiculously priced, and more optimistic than 2011 when it was ludicrously priced, but it's still significantly overvalued. And secular bear periods come back to test the prior cycle lows. So it's not because I say so, it just happens to be the behavioral pattern that we exhibit. And so that means that perhaps 8,000 is something like the secular support in this particular run, and we could see that as a downside test in the not too distant future once the economic data confirms the contraction in North America. So the bottom line is we're making progress in this secular bear, for sure. It started in 2000, we're 13 years in. It's been a very struggling journey for people that have not been aware of the climate that we're in. But the interventions by central bankers, you see that black line, the S&P, that is not a healthy hangover. That's like a cliff that needs to come back down again. So people that have, again, thought that the worst was all behind us and we were out of the secular bear and we could only go up from here, I think that there's a lot of risk to capital on that thesis. And now, the good news is that if we get another major decline with this next recession, it could be the final and third recession of the secular bear. And typically that will be the capitulation where those that aren't prepared will throw in the towel, prices will become the most attractive in 20 or 30 years, and people with liquidity will be able to take advantage of them. Companies that are able to navigate themselves through this next little bit of stress and keep their cash and not waste it on buying back shares to try and keep things where they ought not to be, if they can actually look for an investable business model, they will have opportunities again, which will be really remarkable. And that's really exciting. But first of all, we have to get through this next contraction phase. And I don't think it's too far off. I mean, it could be, more than a year, but I suspect it's closer than that. And that's the good news. So thank you for listening.